Okay, so you found the property. The numbers are perfect. You're ready to make an offer, but then panic sets in. Wait, how am I going to pay for this? Banks take 45 days. They want 2 years of tax returns. They won't finance a property that needs repairs. So what do? This is where you use a hard money loan. This is how I fund my deals. This is how most investors fund their deals. In the next 5 minutes, I'm going to show you exactly how this works, when to use it, and what to look out for. Because here's the thing. The investors who can close fast are always the ones that win, and they use hard money. All right, so what is a hard money loan? Well, it's sometimes referred to as a fix and flip loan. It's short term. It's usually only 6 to 12 months, sometimes a little bit longer. It has higher interest rates, but we'll talk about that later. And it's different from a bank loan. Banks look at you, your income, your bank statements, your tax returns, but hard money lenders look at the deal. What's the property worth? What will it be worth when it's fixed up? Does the deal make sense? Those are the types of things that they look at. See the difference? They care way less about your personal finances and way more about whether the property is a good investment, and that's why it's perfect for a fix and flip. So why do smart investors use hard money instead of traditional financing? Well, there's really 3 reasons, and I'm going to tell you about them. Number 1 is clearly speed. Banks need 30 to 45 days to close. Hard money lenders can usually close in anywhere from 5 to 10 days. When you're competing for a property, speed always wins, and sellers love when you can close quickly. Reason number 2, they fund properties that need work. Banks will not finance a house with a broken furnace, no flooring, or a roof that needs replacing. Hard money lenders, that's their specialty. They expect you to buy a house that needs work. Reason number 3, they don't care about your income. Self-employed? Great. Between jobs? Totally fine. You quit your W-2 to do this full time? That's not a problem. As long as the deal makes sense, they will fund it. This is why so many new investors start with hard money. It removes the biggest barrier for entry. Okay, before we go any further, I need you to understand these next 3 things. They are very important. Number 1, you need to know your ARV. ARV is after repair value. It's what the property is going to be worth after you fix it up, and it has to be accurate. This is the main number a hard money lender will look at. It determines how much your lender is going to lend you. Typically, hard money lenders lend a percentage of ARV. So the combined purchase amount plus the rehab amount will be a max percentage of ARV. The next thing you need to know, number 2, is your rehab budget. You have to make sure this is thorough and accurate. Get written estimates from your contractors. If you need help with this, find somebody who's experienced to guide you through it, but it is so crucial that you have an accurate rehab budget. Number 3, your exit strategy. Are you going to sell the property or are you going to refinance it? This is a short-term loan and you have to have a solid exit strategy and preferably a backup plan just in case. What happens if it doesn't sell? Can you do a refinance and rent it out? What would that look like? These are all things you need to understand before going into it. So now you're probably thinking, these hard money loans are awesome. Why don't we use these all the time? Well, there are some drawbacks. Here's the 3 biggest and a little tip at the end. Like I mentioned earlier, interest rates are much higher, usually anywhere between 9 to 12%. Before you freak out, you have to remember these are annual interest rates, and you are holding the property for short term, hopefully not even a year. So for example, 12% annual interest rate would be 1% of interest per month. On a $150K loan, that'd be $1,500 a month. On a $200K loan, that's $2,000 per month. Now, the numbers still have to support it, but it's much more doable than people think. Number 2, there are other fees you have to consider. Sometimes lenders charge points, sometimes higher closing costs. Again, these are all things you can account for in your numbers. You just have to know ahead of time. Number 3, you still need to bring a down payment. It may only be 10, 15%, but the lender likes to see that you have some skin in the game. Number 4, lenders usually, not always, but usually, they will check your credit score. They don't expect it to be perfect. I've even seen some lenders go down into the 500s, but always ask before you begin the process so you know what you're in for. Here's that bonus I mentioned to you. If you don't have a lot of experience, some hard money lenders will give you a better rate if you partner with somebody that has a little bit more experience. So you may be able to check around, see if you can partner with a more experienced investor just to get a better interest rate. If you're interested in diving in deeper, I have some free resources below. Check them out.